Hi, thanks for visiting my channel. For anyone new to this channel, my name is Tanveer Chaudhary. I'm a certified financial planner and real estate investor, and I make educational videos regarding wealth building, financial planning, and real estate investing. I make one fresh video every week. You can visit my channel and find videos about different financial planning and real estate investing topics. Before we get started, if you think you learn at least one new thing from this channel, all I ask is to subscribe to this channel so more financially savvy people like you can benefit from this information. Today we are not talking about the most common tax deduction you can claim against your rental income. For example, mortgage interest, property taxes, condo fees, property insurance, any utilities paid by the landlord, maintenance and repair of the rental property, automobile expenses, or home office expenses. Today we are talking about the 3 tax write-offs most often missed by real estate investors. Before we start talking about the yearly tax write-off, any fees you pay to acquire the property initially are not deductible against your yearly rental income. They include any legal fees, cost of title insurance, land transfer taxes, any development charges, property inspection fees, or any appraisal costs. These costs get added to the initial cost of acquiring the property and increases the adjusted cost base or ACB of the property and help you reduce the capital gains when you sell the property. Most of these costs are listed on the statement of adjustment or trust ledger you receive from your real estate lawyer upon closing the property. These costs are outside of the scope of this video, but a great topic for another video. Tax write-off number 1 often missed by real estate investors is the financing costs you pay when you acquire the rental property. These costs include any lender fee, any broker fee, any default insurance premium you pay to any default mortgage insurer like CMHC. These costs are 100% deductible, but you cannot deduct the entire financing costs in 1 year. These expenses have to be claimed over a 5-year period, which means 20% per year. These expenses are claimed as interest charge on line 8710 of T776, which is Statement of Real Estate Rentals. Let me give you an example. If you purchase a property in 2023, you can claim 20% of the financing cost in year 2023 and 20% in each of the next 4 years. These costs are usually listed on the statement of adjustment you receive from your real estate lawyer. Tax write-off number 2 often missed by real estate investors is the capital cost allowance or CCA, and this is the big one. You can write off the purchase price of the building since the building itself, excluding land, wears out and become obsolete over time. Therefore, you can deduct that cost over the period of next several years. You have to separate the cost of the building from the cost of the land since you can only depreciate the cost of the building. You can typically find the value of the land on the property assessment notice or through the property appraisal. According to CRA, most of the residential buildings fall under class 1 of the CCA categories. Therefore, you can write off maximum of 4% of the purchase price of the building every year. You do not have to claim the maximum CCA allowed in any given year. You can claim any amount you like from 0 to maximum allowed for the year. If you do not have to pay income tax for the year, you might not want to claim CCA for that year. In the year you acquire the rental property, you can only write off 50% of the eligible capital cost allowance due to half-year rule. Each year you claim capital cost allowance, it reduces your undepreciated capital cost of the property, and any undepreciated capital cost gets carried forward to future years. Important thing to remember about CCA that you can reduce your rental income to 0 by claiming CCA, but you cannot show a rental loss by claiming capital cost allowance tax deduction. Capital cost allowance tax deduction against your rental property is more like RRSP, and it's a tax deferral tool where you get tax deduction initially when you claim the CCA, but you have to recapture it when you sell the property, and any CCA gets added to your income for that year and you have to pay capital gains. General rule of thumb is if you're in a higher tax bracket today, consider claiming capital cost allowance against your rental property since the dollar saved in taxes today is better than dollar paid in taxes years from now when you sell the rental property due to the time value of money. Tax write-off number 3, often missed by real estate investors, is the interest expense on the line of credit or HELOC used for down payment to purchase the rental property. It's very common for real estate investors to purchase rental property using borrowed funds from HELOC against their principal residence. Borrowing entire down payment from line of credit to purchase rental property is a great strategy to purchase rental property with zero down, as long as you can debt service it. Every real estate investor knows to write off the mortgage interest paid on the rental property, but they often forget to add the interest expense from the line of credit they used to borrow the down payment. Important thing to remember before using HELOC as a down payment on the rental property, that you have to keep the paper trail that how funds were transferred from the credit line to be used for down payment on the purchase of a rental property. You may want to ask your financial institution to create a separate segment within your HELOC limits used solely for down payment to keep track of the interest paid every year on that segment of the line of credit. That's all for this video. If you think information like this can benefit someone, please share this video. Also like, comment below, and consider subscribing. Thanks for watching, and see you in the next video.